Welcome to the next Valor Capital real estate educational video. In today's video, I'll be covering how we define and how a lot of people define overall market size for real estate markets. There are three main categories of real estate market by size: primary markets, secondary markets, and tertiary markets. Primary markets will be your largest metropolitan areas. These are typically going to be metropolitan areas that have probably over 5 million or likely over 2.5 million people. The list of cities that are included in this list varies, but predominantly it's going to be your 5 to 10 largest cities in the United States. Your secondary markets are going to size from a quarter or a half million to 2.5 million people. These are typically going to be cities that are well known, uh, are typically the largest city within its state, but are simply not one of the 10 largest cities in the United States. Good examples of large secondary markets include Denver, Kansas City, and Las Vegas. Finally, you get into tertiary markets, which are your smallest markets. And this can really include really any small towns all the way up to roughly a quarter million or a half million in population. And what really determines the type of market is more around the overall employment base. And that's going to be a major factor in determining the type of market and the risk within that market. So in primary markets, you're going to see the lowest cap rates, which really means people are paying the most per dollar of earnings for for those assets, but they're also typically the safest, meaning that property values hold very well, sort of regardless of performance or regardless of operations in large primary markets. One of the reasons for this is that primary markets have very strong, diversified economies, and there's also lots of capital and lots of buyers and sellers for those assets within those markets. Secondary and tertiary markets are going to have less diversified overall economic basis, meaning there's going to be fewer total employers and fewer types of employers in each city. Typically, you also see strong industry concentration within secondary and tertiary markets, meaning that these cities are typically going to have a very predominant industry focus, which you don't see as much within major primary markets. A good example of this would be Las Vegas. Las Vegas is dominated by the entertainment industry and hospitality industries. You do have other industry within Las Vegas, such as banking, distribution, and transportation, but really the economic center is centered around tourism and hospitality. Another example would be Midland, Texas, which is a city that's heavily anchored by oil and gas exploration activities. And the reason I bring up this specialization within these markets is this is really why you have higher cap rates, because this is the main source of risk within the markets. Because when these industries, or if the local industry within a secondary or tertiary market goes into recession, the market performs very poorly. And this is really the extra risk that you're taking by investing in one of these economies. And this is why you're being compensated with higher cap rates, meaning that there's more overall return potential. One of the other major advantages in secondary and tertiary markets is there's usually less new development occurring, meaning that there's usually more constrained supply than what you see in primary markets. And so within a secondary and tertiary market, if you have a strong performing real estate asset, this can be an advantage that lasts typically longer than what you might see otherwise in a primary market. So just to recap, there's three main types of markets. The main determination is overall population, but also you can take a look at how diversified an economy is. Primary markets will have the most diversified economies and are typically the safest real estate investment markets, but that also means lower return potential. And tertiary markets are going to be the highest risk, but also have the most return potential. When we look at secondary and tertiary markets, my main determination is looking at the overall number of economic bases within the marketplace. If you have a very diversified economy, that's going to make a very robust categorization as a secondary market. And if you have a very heavily uh, focused economy, that's likely going to be more of a tertiary market categorization. Well, thank you again for joining us on this video. This is Jordan Speaker with Valor Capital. Thank you for watching.